Hey there and welcome back. Ready for the lowdown on Lux Industries Q2 results?
Fiscal year 25, right?
You got it. We've got company filings, press releases, a whole mountain of info.
Investor presentations too, don't forget those.
Oh, absolutely. So much to unpack. Let's dive right in with this deep dive, shall we?
Let's do it.
First things first, quick context for everyone. Lux Industries, they're already huge in India.
The biggest name in innerwear by volume, for sure.
Exactly. Maybe you've even seen some of their ads.
With those big Bollywood names, right?
Yeah, like Varun Dhawan and Amitabh Bachchan. Remember those Lux Koozie ads?
Oh yeah, those are iconic.
Totally. But it seems like Lux Industries is branching out, you know?
Way beyond just men's innerwear. They're transforming, becoming this omni-channel.
Omni-channel, what does that even mean?
Basically, they're everywhere. Think online, retail, new markets, the whole 9 yards.
And they're even making moves in sustainability.
That's right. They're not just about profits anymore. They're thinking long term.
Got it. So this deep dive, it's not just about crunching numbers.
It's about understanding how Lux Industries is shaking things up.
I love it. All right, let's start with the big news. What's the headline here?
Well, Lux Industries just had a really strong Q2.
How strong are we talking?
Their profit before tax jumped over 62% compared to last year.
Whoa, 62%. That's got to be great news for their investors.
Definitely. Especially when you consider the current economic climate.
True. Things have been a bit tough in India lately, right?
Absolutely.
Yeah.
Consumer demand has been down because of inflation.
Makes sense. So for Lux Industries to pull this off, that's pretty impressive.
It really is. It shows they're making smart choices and adapting to the market.
So it's not just about bringing in more revenue. It's about maximizing profits.
Exactly. And they're doing a great job of that.
Okay, so their revenue growth was good, about 4% year on year.
For the first half of the fiscal year, yeah.
But the real story is their profitability, right?
You nailed it. They're squeezing more value out of every sale.
Okay, I'm intrigued. To understand how they're doing this, we need to break down their business.
Yeah, let's peek under the hood, so to speak.
Tell me more. What's their structure like?
Well, they've reorganized into 3 distinct business verticals.
Verticals, like silos.
Kind of. They call them A, B, and C.
Interesting. Is this a common thing for companies like Lux Industries?
More and more businesses are doing it. It provides more transparency for investors.
And that can boost confidence, right?
Absolutely. It's like showing them you have nothing to hide.
Okay, so tell me about these verticals. What's the strategy behind each one?
All right, so vertical A, that's their core business. Think brands like Lux Koozie.
Their flagship brand.
Right.
Exactly.
ONN and Lux Cotswool are also in there.
And they're seeing a lot of growth there.
Huge volume growth, yeah.
So they're sticking with what they know and do best in vertical A.
Makes sense, right.
Totally. What about the other verticals?
Okay, vertical B, this is where they're aiming for higher-end products.
Higher quality, higher prices.
Exactly. They're calling it premiumization.
Fancy word.
I know, right? So this is where you'll find brands like Lux Venus.
I've heard of that one.
They're doing well in the women's innerwear market. Lyra is in this vertical too.
That one's really popular, I think.
It is. And then there's Lux Inferno.
Gotcha. So they're not just a one-trick pony anymore.
Nope, they're diversifying their offerings and targeting different customer segments.
Smart move. And what about vertical C? What's their game plan there?
Vertical C is all about value. Think affordable, reliable products.
For the budget-conscious consumer.
Exactly. Brands like Gen X, Lux Classic, and Lux Karishma fall under this vertical.
Okay, so they've got all their bases covered, different verticals for different needs.
Exactly. It's a smart way to capture a larger share of the market.
But is it just about segmentation? Or is there something more to it?
There's definitely more to it. If you look at the bigger picture, Lux Industries is making strategic investments in their manufacturing.
Okay.
And in brand building, too. They're shifting from volume to brand power.
Interesting. And we could actually see this reflected in their financials, right?
Absolutely. Their debt-equity ratio is down significantly.
Which means?
It means they've paid off a lot of debt. They're less risky now.
And that gives them more flexibility to invest, right?
Exactly. It's like having more cash in your pocket.
Okay, that makes sense. Anything else standing out in their financials?
Their working capital days have improved, too. By a lot, actually.
Working capital days. Remind me what that means again.
Basically, it's how efficiently their money is working. Think of it like a machine.
And it's running smoothly.
Like a well-oiled machine. They're getting products to market faster.
And collecting payments quicker.
Yep. It's all about efficiency.
Wow. 24 days. That's huge. No wonder their profitability is soaring.
It all adds up. They're laser-focused on streamlining everything.
Okay, so they're all about efficiency and profits. But are they overlooking anything important?
Like what?
Like sustainability, for example. Are they thinking about that at all?
Oh, absolutely. That's actually one of the most remarkable things about them.
Really? Tell me more. What are they doing in terms of sustainability?
Well, they're going beyond just talking the talk. They're actually walking the walk.
Okay, stop being so cryptic and give me the details. What are they actually doing?
They're incorporating sustainable practices across their entire business, from their products
To how they treat their employees.
to their supply chains, their factories, everything.
That's fascinating. So it's not just a marketing ploy. They're really committed to it.
They are. It's a core part of their business now.
All right, I'm impressed. Give me some specifics. What kind of initiatives are we talking about here?
For starters, they're using more natural fibers in their products.
Okay, makes sense.
What else? And they're switching to recyclable packaging.
Smart move. Less waste is always a good thing.
They're also sourcing materials locally whenever possible.
Oh, interesting. So reducing their carbon footprint and supporting local communities?
Exactly. Two birds with one stone.
Okay, I'm liking what I'm hearing so far. What about their employees? How are they factoring into all of this?
They're putting a huge emphasis on employee well-being. Fair labor practices, diversity and inclusion, the whole package.
So they're taking care of their people.
Huh?
And they're also going above and beyond with CSR, right?
Absolutely. They're making a real difference with their corporate social responsibility activities.
Yeah. You know, I'm always a little skeptical about companies' CSR claims.
Well, I get it. Sometimes it feels like a PR stunt.
Exactly. But you're saying Lux Industries is actually making a difference.
Oh, definitely. They're not just writing checks, they're actively involved.
Okay, give me an example. What kind of initiatives are they supporting?
Well, they built a school for underprivileged children in Murshidabad.
Wow, that's amazing. How many kids go there?
Over 100 students are getting an education thanks to them.
That's incredible. Anything else?
They also contributed to a free residential school for girls in Joka, West Bengal.
Wow, a residential school. That's a big commitment.
It is. They're providing a home and education to over 1,000 underprivileged girls.
That's pretty amazing.
Yeah.
I have to admit I'm impressed by their commitment.
It's genuine, you can tell.
They're not just talking about making a difference. They're actually doing it.
Exactly. And it aligns perfectly with their brand values and what consumers are looking for these days.
Makes sense. People want to support brands that are doing good in the world.
It's not just about the product anymore, it's about the company behind it.
Right. So their commitment to sustainability and CSR, it's not just ethically sound.
It's a smart business strategy, too.
Makes you feel good about buying their products, knowing that you're indirectly contributing to a good cause. So far, we've covered a lot of impressive financials, strategic shifts, impressive ESG initiatives. It sounds like Lux Industries has a lot going for them. What's next for them? Any ambitious plans in the works?
Oh, yeah. They've got some big plans for growth, starting with a brand new production facility.
A whole new facility. Where is it?
In Kolkata's hosiery part. It's state-of-the-art, designed to help them meet future demand.
Okay, so they're scaling up production. What else?
They're also expanding their retail footprint. More stores, more visibility.
Interesting. And of course, we can't forget about the online world.
Absolutely. They have aggressive growth targets for their online sales.
It seems like they've got all their bases covered. They're ambitious, they're innovative, they're socially responsible.
They're a force to be reckoned with, that's for sure.
It's inspiring, for sure. But all this ambition, it begs the question, can they maintain this momentum?
It's a good question. The global economic environment is still uncertain.
So many challenges.
Exactly. Their success will depend on their ability to adapt and stay ahead of the curve.
I guess we'll have to wait and see how it all unfolds. But one thing's for sure.
What's that?
Lux Industries is a company to watch. They're doing some amazing things.
Couldn't agree more. They're setting a new standard for the industry.
All right, let's take a quick break here. When we come back, we'll delve deeper into those three business verticals, A, B, and C. We'll see how they're each performing and what challenges they're facing.
Sounds good. Can't wait to break it all down. All right, let's jump back into those business verticals.
Yeah, let's break them down one by one.
Starting with vertical A.
The volume king.
Exactly. Big numbers, mass market brands, that's their game.
So give me the rundown. What kind of revenue we're talking about here?
In Q2 FY25, their revenue from vertical A hit 291.96 crores.
Crores with a C. That's impressive. How did that compare to last year?
It's up over 13% from the same quarter last year.
Wow, over 13% growth, even with the economic headwinds we discussed.
That's right. They're defying the odds.
What's the secret sauce? Is it just Lux Koozie, or are other brands pulling their weight too?
Lux Koozie is definitely the star player. It saw a volume growth of about 16% in Q2.
Okay, so the flagship brand is doing its job. Anything else contributing to that growth?
They're also seeing good results from some of their smaller brands.
Which ones?
The ones lumped into the other category,
Yeah.
they saw a 55% jump in sales.
55%, that's huge.
It is. So it's a combination of their core brand performing well.
And some smart diversification within the vertical.
You got it. But revenue is just one piece of the puzzle.
Right. What about profitability? Are they actually making money?
Oh, they're making money all right. Their EBITDA for Vertical A in Q2 landed at 35.1 crores.
Okay, so that's earnings before interest, taxes, depreciation, and amortization.
Right. Exactly. It's a key measure of operating profitability.
And that's up how much from last year?
A hefty 38% increase?
Wow, they're killing it. And what about profit before tax?
A cool 30.1 crores, up 42% year on year.
Okay, so their focus on volume growth is definitely translating into profits.
No doubt about it. But they're not just growing, they're becoming more efficient too.
Right, we talked about those working capital days earlier.
Exactly. And we're seeing those improvements reflected in Vertical A's performance.
Give me the numbers. How much of those inventory turnover days improved?
They've dropped from 126 days in the first half of last year to 113 days now.
So they're managing their inventory much better.
Much more efficiently. And their debtor turnover days have improved too.
Meaning?
They're getting paid faster. Down from 103 days to 88 days.
So their cash flow's looking good.
Very healthy. All these improvements point to a stronger financial position.
So to sum it up, Vertical A is performing well across the board.
Couldn't have said it better myself. They're growing, they're profitable, they're efficient.
A well-oiled machine.
Precisely. Now, let's move on to Vertical B. Remember, this is their premium segment.
Right, the one with those aspirational brands. Lux Venus, Lyra, all those.
And don't forget Lux Inferno.
Oh yeah, their premium men's innerwear brand.
They're really trying to elevate their brand image with Vertical B.
Appeal to a different kind of customer, one who's willing to spend a bit more.
Exactly. And they're doing some interesting things in this space.
Like what?
Well, remember their move into the rainwear market?
Oh yeah, with Lux Venus rainwear.
That was a bold move, expanding beyond innerwear, tapping into a whole new category.
It's definitely a departure from their traditional offerings. But how is Vertical B performing overall? Are those premium products resonating with consumers?
Well, it's a bit of a mixed bag, honestly. In Q2 FY25, their revenue came in at 295.04 crores.
How does that compare to last year?
It's actually down slightly from the 303.01 crores they reported in the same quarter last year.
So a slight dip in revenue. Not exactly the kind of explosive growth we saw with Vertical A, huh?
Nope. But remember, it's a different strategy. Premiumization is about higher margins, not necessarily massive volumes.
That makes sense. So it's not just about how much they're selling, but what they're selling and at what price.
Exactly. And within Vertical B, some brands are exceeding expectations while others are facing some headwinds.
Give me the details. Which brands are struggling and which ones are shining?
Well, their Lux Inferno brand, the men's premium innerwear line, saw a significant drop in sales.
How significant are we talking?
Almost 30% year on year. It seems like they might need to reevaluate their approach there.
Ouch, a 30% drop. That's got to sting.
It does. But here's the silver lining. The strong performance of their Lux Venus brand helped offset some of those losses.
So Lux Venus is doing well.
Relatively speaking, yes. They saw a modest growth of about 2.6%.
Okay, so not a runaway success, but at least it's moving in the right direction.
Exactly. And their bet on rainwear seems to be paying off too.
So some wins and some losses within Vertical B. But what about the bottom line? How did their EBITDA and PBT look?
Despite the dip in revenue, they're still managing to grow their profits.
That's encouraging. Give me the specifics.
Their EBITDA for Vertical B in Q2 came in at 37 crores, a solid 20% increase year on year.
Okay, so they're making more money from their operations, even with that revenue dip. What about profit before tax?
PBT landed at 34 crores, up a respectable 13% year on year.
So all things considered, not bad at all. They're maintaining profitability even when some brands are facing challenges.
Exactly. And that tells me they're managing their margins effectively.
And focusing on those higher value products.
Exactly. We can actually see this in their average selling price, or ASP.
Remind me what that means again.
It's basically the average price they're getting for their products.
And it's going up.
It's increased slightly for both Lux Venus and Lyra.
So they're moving in the right direction with their premiumization strategy.
They are. But let's not forget about those operational efficiency metrics.
Right, inventory turnover and working capital days, those things. How is Vertical B performing in those areas?
Well, their inventory turnover days have actually increased slightly.
Uh-oh, that doesn't sound good.
It's not ideal, but there could be a few reasons for it.
Like what?
Well, they've introduced new product lines, like that rainwear we talked about.
Okay, that makes sense.
Yeah.
New products often require more lead time for production and distribution.
Exactly. So it's not necessarily a cause for concern, but it's something to keep an eye on.
Agreed. And what about their debtor turnover days? Are they still collecting payments efficiently?
Yes, their debtor turnover days for Vertical B have actually improved,
Okay, so that's good news.
down from 78 days to a lean 71 days.
So their cash flow management is still strong.
Very strong. They're keeping that money moving.
Overall, it seems like Vertical B is showing some positive signs, but there are definitely areas for improvement.
I think that's a fair assessment. They need to figure out what's going on with Lux Inferno.
Right. And they need to keep a close eye on those inventory levels.
But they're clearly committed to this premiumization strategy, and they're making progress.
All right, let's move on to our final vertical C, the value segment.
The land of affordable quality.
Exactly. This is where we find brands like Gen X, Lux Classic, and Lux Karishma.
Brands that cater to the budget-conscious consumer without compromising on quality.
And we can't forget about their new brand, Lux Amour.
Right. They launched that last year, further expanding their offerings in this segment.
It might not be as flashy as their premium brands,
But it plays a crucial role in their overall strategy.
reaching a wider audience, capturing a bigger market share, it's all connected.
Absolutely. So let's dive into the numbers. How is Vertical C performing?
Give me the highlights.
Their revenue from Vertical C reached 90.45 crores in Q2 FY25.
Okay, and how does that compare to the same period last year?
That's a year-on-year growth of nearly 10%. Not bad at all.
Nearly 10% growth, that's pretty solid,
Right.
especially in this economic climate.
You're holding their own, that's for sure.
What's driving this growth? Any particular brands standing out?
Lux Classic is doing quite well. They saw an 18.5% jump in sales year-on-year.
So the old reliable is still pulling its weight.
Yeah.
What about the other brands?
Well, their Gen X brand is actually facing some challenges.
Uh-oh, what kind of challenges?
Their sales declined by about 24% compared to last year.
So it's a bit of a mixed bag here, too. Some brands are up, some are down.
It seems to be a recurring theme across all three verticals.
It's the nature of the beast, I suppose. Always some winners and losers in the market.
True, but what's really interesting is that despite these fluctuations,
Yeah.
Vertical C is seeing some impressive gains in profitability.
Okay, tell me more. What kind of numbers are we talking about?
Their EBITDA for Vertical C hit 8 crores in Q2. That's an 85% increase from last year.
85%, that's massive. And profit before tax.
An even more impressive 12 crores, up 56% year-on-year.
So they're managing their margins really well within this segment.
They are. Even with some brands experiencing a sales decline, their overall profitability is up.
That's smart business. What's their secret?
They're clearly adaptable and focused on the bottom line, and they're not overlooking operational efficiency either.
Give me the stats. How are those efficiency metrics looking?
Their inventory turnover days have improved significantly, dropping from 149 days to 123 days.
So they're moving products faster. And their debtor turnover days.
Also improved, down from 157 days to 144 days.
Okay, so they're collecting payments quicker too. It sounds like they have a good handle on their operations in Vertical C.
They do. They're becoming leaner and meaner.
So some bumps in the road, but overall, Vertical C is showing positive signs.
Definitely. They're growing their profitability, tightening their operations, and they're well-positioned for future growth.
It's a good reminder that success often requires a long-term perspective.
And a willingness to adapt and evolve.
All right, we've covered a lot of ground here talking about all three of their business verticals. But I'm curious, you mentioned earlier that Lux Industries is going beyond just men's innerwear.
Right. Their transformation is about more than just new brands and verticals.
Give me the details. What else are they doing to shake things up?
Well, one of the most exciting things is their push into women's innerwear and outerwear.
Yeah, we touched on that earlier with their Lyra brand. That one seems to be doing really well.
It's become a market leader in a remarkably short amount of time.
I've seen their ads everywhere. Jacqueline Fernandez is their brand ambassador, right?
That's right. They've really gone all in on marketing and branding for Lyra.
And it seems to be paying off. What's driving their success in the women's market?
Well, for one, they've tapped into a real need. Women are looking for comfortable, stylish, and affordable innerwear options.
And Lux Industries is delivering on that,
They are. And they're not just relying on their existing brand recognition either.
meaning.
They're building a distinct identity for Lyra. Their marketing is very targeted and resonates with their target audience.
Makes sense. So they're putting in the work to establish Lyra as a separate entity, not just an extension of the Lux brand.
Exactly. And they're offering a wide range of products under the Lyra brand.
Like what? Fill me in.
Bras, panties, leggings, activewear, the whole shebang.
Okay, so they're covering all the bases. And they're expanding into loungewear and shapewear too, right?
They are. They're really tapping into those current trends, focusing on comfort and functionality.
So they're listening to what women want.
And they're responding with products that meet those needs.
Smart move. And what about their outerwear expansion? You mentioned earlier that they've launched winterwear collections.
They have, under their Lux, Venus, Lyra, and ONN brands.
So they're offering thermal wear, sweaters, jackets, the whole winter wardrobe.
They are, targeting both men and women with these collections.
So they're becoming a more comprehensive apparel brand, not just an innerwear specialist.
They are. It's a bold move, for sure. But they're clearly aiming to capture a larger share of the consumer's wallet.
I can see the logic there. Offer a wider range of products, become a one-stop shop for your customers.
Exactly. It's a way to increase customer loyalty and drive sales growth.
But entering new product categories can be risky, right? Are they facing any challenges in this expansion?
There are always challenges when you're venturing into new territory.
Competition, changing trends, all those things.
Exactly. But they seem to be navigating them well.
How so?
Well, they're leveraging their existing strengths, their manufacturing expertise,
That strong distribution network.
and their marketing prowess. They're not starting from scratch. They're building on what they already have.
Okay, so it's a calculated risk. They're not just jumping in blindly.
Nope. They're doing their homework and mitigating those risks as much as possible.
So far, so good then. Okay, we've talked about their expansion into women's innerwear and outerwear, their winterwear line. It's clear they're not standing still. But all this expansion requires manpower, right?
It does. You need the right people to execute these ambitious plans.
How are they managing their workforce as they grow?
They've got a great team in place, a mix of industry veterans and fresh faces.
Okay, let's talk about the people behind this success. Who are the key players driving this transformation?
Well, at the top, you've got Ashok Kumar Todi, the chairman.
He's been with the company since the beginning, right?
He's the founder and promoter with over 5 decades of experience in the hosiery business.
5 decades. That's incredible. He must have seen it all.
He has. His expertise lies in capturing market share, developing marketing strategies, and formulating growth plans.
So he's the visionary, the big picture guy.
Exactly. And he's the one who came up with those clever schemes that won over dealers and retailers.
Making them loyal partners, crucial for any business.
Absolutely. And then you have Pradeep Kumar Todi, the managing director.
Okay, so he's the one responsible for the day-to-day operations.
You got it.
Yeah.
He's also a founder and promoter, but his focus is on product development and production.
So a strategic leader with a long-term vision and a technical expert who keeps the wheels turning. Sounds like a winning combination.
It is. And they've got a strong next generation coming up through the ranks, too.
Really? Tell me more about that.
Navin Kumar Todi, Saket Todi, Udit Todi, and Rahul Kumar Todi are all actively involved in the business.
So it's a family affair.
It is. And they're bringing fresh perspectives and new ideas to the table.
It's great to see that blend of experience and fresh blood.
Absolutely. But they're not just relying on family members. They've also brought in some top-notch professionals to lead key functions.
Give me some names.
Well, they've got Ajay Nagar as their CFO, Smita Mishra as their company secretary and compliance officer.
Okay, so they're covered on the finance and legal side.
Right.
What about technology?
They have B. Bekmady as their CIO chief information officer.
So they're investing in their IT infrastructure, keeping up with the times?
Exactly. They understand that technology is crucial for their future growth.
All right, so we've got the C-suite covered. Any other key players we should know about?
Their management team is full of talented individuals. Surendra Kumar Bajaj, their VP of Marketing, and Sanjay Mittal, their VP of Sales, are both instrumental in driving their success.
So they've got a strong team from the top down.
They do. And they're not forgetting about the people on the front lines either. Their workforce consists of over 3,350 employees.
Wow, that's a lot of people.
It is. And they have a vast network of over 11,170 dealers across India.
So they're reaching customers all over the country.
They are, and those dealers are sticking around too. Their dealer attrition rate is less than 1%.
That's pretty impressive. It shows they value their partners and treat them well.
It does. They understand that strong relationships are key to their success.
Okay, let's shift gears a bit and dive into their financials. We talked earlier about their profit before tax jumping over 62% in Q2. Can you give me the actual figure?
66.75 crores.
66.75 crores. That's a lot of money. And how does that compare to the same quarter last year?
It's a big jump from the 46.05 crores they reported last year.
Okay, so we've established that they're making good money. But can you break it down for me? What were some of the key financial moves that contributed to these results?
Well, one of the biggest things was their debt reduction.
Right, we talked about their debt-to-equity ratio being down, so they're carrying less debt, making them less risky for investors.
Exactly. And that gives them more financial flexibility.
To invest in growth initiatives, pay dividends, all those good things.
Right. And their debt-to-equity ratio is now down to 0.12.
A significant improvement from the 0.17 it was at the end of last year.
They're definitely moving in the right direction.
Okay, so they're managing their debt well. What about their working capital?
Also a bright spot. Their working capital days have improved by 24 days year on year.
Meaning they're getting products to market faster and collecting payments quicker.
Exactly. Their money machine is running more efficiently.
All thanks to those improvements in inventory and receivables management.
You got it. They're turning over their inventory faster.
Their inventory cycle is down to 107 days from 117 days last year.
So they're not sitting on a lot of unsold products.
And they're getting paid more quickly.
Keeping that cash flowing, it's a beautiful cycle.
It is. But with all this talk about financial prudence, one might think they're being overly conservative, right?
Not at all. They're actually quite aggressive when it comes to brand building.
Right, we talked about all those celebrity endorsements they're doing.
Salman Khan, Sourav Ganguly, Jacqueline Fernandez, Vijay Deverakonda, Varun Dhawan. They've got a star-studded lineup.
It's like a who's who of Bollywood and cricket. But those endorsements must be expensive, no?
Oh, they are. They've spent a whopping 1,085 crores on branding over the past 7 years.
1,085 crores. Wow. They're clearly serious about building those brands.
And it's paying off. They're seeing a return of 13 rupees for every rupee spent on branding.
That's a pretty impressive ROI.
It is. It shows their marketing is working.
So they're not just throwing money around, they're making strategic investments that are generating real results.
Exactly. They understand the power of a strong brand.
And they're not just relying on star power either.
Right. They're building their brands across different price points.
So they're catering to a wider range of consumers, different budgets, different needs.
Exactly. They have brands for the mass market, the mid-premium segment, and even the premium category.
So they've got all their bases covered. And of course, we can't forget about their online presence.
They're expanding aggressively in the e-commerce space.
Listing their products on all the major platforms.
Amazon, Flipkart, Tata Click, Myntra, AJIO, you name it, they're there.
And they have some ambitious targets for online sales, right?
They're aiming to hit 100 crores in revenue from e-commerce within the next 3 years.
100 crores, that's a bold target.
It is. But considering they're already getting over 4,000 online orders a day, it's not out of reach.
Okay, so they're definitely positioning themselves to capitalize on that growing e-commerce market.
They are. They understand that's where the future of retail is headed.
And they're investing in the infrastructure and technology needed to succeed in that space.
Exactly. They're not just dipping their toes in the water. They're diving in headfirst.
Speaking of diving in, let's talk about their manufacturing capabilities. Their commitment to quality and innovation is something we haven't really touched on yet.
It's definitely one of their key strengths.
They've been in the hosiery business for over 3 decades.
Right. That's right. And that experience shows in their efficient and flexible manufacturing processes.
And they're not afraid to embrace new technology either.
Absolutely. Their factories are equipped with state-of-the-art machinery from all over the world.
Italy, Germany, Singapore, they're sourcing the best of the best.
They understand that investing in technology is crucial for maintaining their competitive edge.
Smart move.
Yeah.
And they've been strategic about the location of the manufacturing units too, right?
Absolutely. They've got plants in West Bengal, Punjab, Tamil Nadu, and Uttar Pradesh, all key markets for their products.
So they're minimizing transportation costs and ensuring timely deliveries.
Exactly. They're thinking about the entire supply chain, from production to distribution.
And it's paying off. Their fill rate is 95%.
Way above the industry average of 80%.
So they're consistently able to meet the demands of their distributors and retailers.
That reliability is crucial for building trust and maintaining strong relationships.
All right, we've talked a lot about their overall strategy. Now, let's break it down a bit further by looking at those three business verticals A, B, and C individually.
Sounds good to me. Where do you want to start?
Let's start with vertical A, the volume-driven powerhouse. We'll see how their key brands are performing and delve into the numbers.
Let's do it. All right, vertical A. All about those big numbers, right? Volume is king here.
Exactly. Give me the lowdown on their revenue. How much are we talking about?
In Q2 FY25, their revenue from vertical A reached 291.96 crores.
291.96 crores. That's a pretty big chunk of change.
It is, and it's a significant jump from last year.
How much of a jump are we talking about here?
Over 13% compared to the same quarter last year.
Over 13% growth, even with all the economic challenges we've been discussing.
It's impressive, for sure.
It is. So what's the driving force behind this growth?
Well, Lux is definitely the star player.
As expected.
Their flagship brand saw volume growth of about 16% in Q2.
Okay, so Lux is doing his part. Anything else contributing?
They're also seeing good results from their other brands category.
Other. What does that include?
It's basically a mix of their smaller brands in that vertical.
And those are performing well?
They saw a 55% jump in sales.
55%. That's a pretty big jump.
It is. So it seems like their strategy of combining a strong core brand
With some smart diversification?
is paying off.
Absolutely. But revenue is only part of the story.
Right. What about profitability?
Are they actually making money from all this volume?
Oh, they're making money all right. Their EBITDA for vertical A in Q2 was 35.1 crores.
A healthy number.
And up 38% compared to the same quarter last year.
That's a big jump.
And their profit before tax was even better, a solid 30.1 crores.
Up how much from last year?
A whopping 42% year on year.
Okay, so their focus on volume is definitely translating into profits.
No doubt about it. But they're not just growing, they're also becoming more efficient.
Right. We talked about those working capital days and inventory turnover.
And those improvements are evident in vertical A's performance.
Can you give me some specifics? How much have their inventory turnover days improved?
Well, they've dropped from 126 days in the first half of last year to 113 days now.
So they're managing their inventory much more effectively.
Much more efficiently. Less waste, faster turnaround times.
And what about those debtor turnover days? Are they getting paid faster?
Yes, they are. Their debtor turnover days have improved from 103 to 88 days.
So their cash flow's looking good.
Very healthy. All signs point to a stronger financial position.
So to sum it up, Vertical A is performing well across the board. They're growing, they're profitable, and they're efficient. Now let's move on to Vertical B, their premium segment. How are those aspirational brands doing?
Well, it's a bit of a mixed bag, to be honest.
Really? Tell me more.
Their revenue for Q2 FY25 came in at 295.04 crores.
So that's down slightly from the same quarter last year.
Yeah, about 2.6%.
Okay, so not the explosive growth we saw with Vertical A.
Nope. But remember, it's a different strategy. They're going after higher margins, not necessarily massive volume.
That makes sense. So what's the breakdown? Which brands are performing well and which are struggling?
Well, their Lux brand, the men's premium innerwear line, saw a pretty significant drop in sales.
How significant are we talking?
Almost 30% year on year.
Ouch, that's gotta hurt.
It does. It seems like they might need to rethink their strategy there.
Yeah, maybe they need to adjust their pricing or their marketing approach.
Possibly. But on a brighter note, the Lux brand is performing quite well.
That's good news.
It saw a modest growth of 2.6%.
Okay, so not a runaway success, but at least it's moving in the right direction.
Exactly. And their rainwear line seems to be doing okay, too.
So some wins and some losses within Vertical B. But what about the bottom line? Are they still managing to turn a profit despite those revenue dips?
They are. Their EBITDA for Vertical B in Q2 came in at 37 crores.
It's a pretty decent number.
It's a 20% increase compared to last year.
So their operating profits are up even with that revenue dip. What about profit before tax?
That came in at 34 crores, up 13% year on year.
So all in all, not bad at all. They're maintaining profitability even when some brands are facing challenges.
Right. And I think that speaks to their ability to manage margins effectively.
And focus on those higher value products.
Exactly. We can see that in their average selling price, which has increased slightly for both Lux Venus and Lyra.
So they're moving in the right direction with their premiumization
Oh,
strategy.
they are. Now let's shift gears and talk about those operational efficiency metrics.
Inventory turnover and working capital days, all that good stuff.
Well, their inventory turnover days for vertical B have actually increased slightly.
Oh, it doesn't sound good.
It's not ideal, but it's not necessarily a cause for concern either.
Why not?
Well, remember they introduced new product lines in this vertical?
Like the rainwear.
Exactly. And new product launches often come with longer lead times for production and distribution.
Okay, that makes sense. So they're holding on to inventory a bit longer, but it's not necessarily a sign of inefficiency.
Right. But it's something to keep an eye on. Now, the good news is that their debtor turnover days have actually improved.
Meaning they're collecting payments faster.
Exactly, down from 78 days to 71 days.
So their cash flow management is still strong.
Very strong. They're keeping that money moving.
So to summarize, Vertical B is facing some challenges, but they're also showing some positive signs. They need to figure out what's going on with Lux Inferno, and they need to keep a close eye on those inventory levels. But overall, they seem to be making progress with their premiumization strategy.
Agreed. Now let's move on to our final vertical C, the value segment.
The land of affordable quality. This is where we find those brands like Gen X, Lux Classic, and Lux Karishma. What's the landscape looking like in this vertical?
It's a competitive space, for sure.
Lots of players vying for those budget-conscious consumers.
Right. But Lux Industries has a strong presence in this market.
And they're continuing to expand their offerings, right?
Absolutely. They launched their new brand, Lux Amour, last year.
So they're not resting on their laurels, even in this more value-oriented segment.
They're constantly innovating and looking for ways to reach new customers.
All right, let's dive into the numbers. How is Vertical C performing financially?
Well, in Q2 FY25, their revenue from this vertical came in at 90.45 crores.
Okay, and how does that compare to the same period last year?
That's a year-on-year growth of almost 10%.
Almost 10%. Not bad at all, especially considering the current economic climate.
They're definitely holding their own in this competitive market.
What's driving this growth? Any particular brands performing well?
Lux Classic, one of their long-standing brands, is doing quite well.
The old reliable.
Exactly. They saw an 18.5% jump in sales year on year.
So they're still attracting those loyal customers who value quality and affordability. What about the other brands in this vertical?
Well, their Gen X brand is actually facing some headwinds.
Uh-oh, not another one.
Yeah, it seems like every vertical has its share of struggling brands.
True. What's going on with Gen X?
Their sales declined by about 24% compared to last year.
A pretty significant drop. Maybe they need to reassess their strategy for that brand.
Possibly. It's definitely something they should be looking into.
So it's a bit of a mixed bag in Vertical C, just like the other verticals. But how's their profitability looking? Are they able to maintain healthy margins in this value-focused segment?
They are. In fact, their profitability in this segment is actually quite impressive.
Okay, give me the details. What kind of numbers are we talking about?
Their EBITDA for Vertical C in Q2 hit 8 crores.
Not bad.
And that's an 85% increase compared to the same quarter last year.
85%. That's massive.
It is. They're clearly managing their margins very effectively in this segment.
And their profit before tax.
An equally impressive 12 crores, up 56% year on year.
Wow, those are some serious gains. It seems like they found a winning formula for profitability in this value-conscious segment.
They have. And they haven't forgotten about operational efficiency either.
Right, those key metrics we've been talking about. What's the story there?
Well, their inventory turnover days for Vertical C have improved significantly, dropping from 149 days to 123 days.
So they're turning over their inventory much faster.
Much faster. And their debtor turnover days have also improved, going from 157 days down to 144 days.
So they're collecting payments more quickly, too. It seems like they've got a good handle on their operations in Vertical C.
They do. They're streamlining their processes and becoming more efficient.
So to sum it up, Vertical C is facing some challenges, just like the other verticals, but they're also showing strong signs of improvement. They're growing their profitability, tightening their operations, and they're well-positioned to capture an even larger share of that value-conscious market.
Agreed. They're proving that you can succeed in the value segment without sacrificing quality or profitability.
It's a testament to their adaptability and their commitment to serving a wide range of consumers.
Well said. Lux Industries is clearly a company with a lot to offer.
Absolutely. And it's been fascinating to take this deep dive into their business and see how they're transforming themselves to meet the challenges and opportunities of the market.
I agree. They're a company to watch, that's for sure.
To all our listeners out there, thanks for joining us on this journey. We hope you found it informative and insightful. Until next time, keep exploring, keep learning, and keep diving deep.